Hello and welcome back to Almus Market Mornings, folks. Your daily dose of financial updates with me, Shikhar Garg. And talking about updates, we've seen a lot of bonds across the globe tumbling, and the latest entrant into it is the Australian benchmark, with the participants expecting another rate hike after not another the first rate hike rather after 2010 for the Australian markets. Now this is just another country which we are seeing or talking about the rate hikes, just as many of the other central banks. Apart from that, we have seen China wrecked into havoc by the coronavirus. Now, this again is a concernable factor for the markets, as one of the largest economies is brought down to knees again by this virus. On the domestic front, we are heading into the IPO week with LIC IPO coming in. So what what are the expectations for the market with all the things into the play? JK, can you tell us what should we expect?
Yeah, good morning. Let's start with how the asset market performed on Friday. We had a big fall in the US markets, and concerns about the economy after GDP contracting, higher interest rates expected, was all topped with Amazon, giving a bad earnings report. And this was a perfect recipe for 4% fall in Nasdaq, 3.6% fall in S&P, and 2.8% fall in the Dow. Now, Nasdaq has lost 25% from its peak, and usually such a fall puts the index in a downtrend. And with rates expected to go higher, this is very likely, because the tech sector has been the big beneficiary of the easy money policy, which the US Fed has followed for such a long time. Surprisingly, Asian markets are not as badly hit as the US market fall. So it's no comfort, because eventually they will catch up, because the rates are going up everywhere. And there is a concern that the global economy is slowing down, particularly after the China's lockdown of its major part of its economy. On the we have a very scheduled week of highly packed schedule of economic data and events of central banks, and also important economic data. We kick off with China's PMI, which in fact has been announced on Saturday, and that's actually shown a big drop, with lockdowns playing a big part. Reserve Bank of Australia meets tomorrow. The market's perception of a likelihood of a rate increase has gone up after last week's stronger than expected CPI. Fed, of course, meets. It's the most well published event, and 50 basis point hike is a foregone conclusion. And 0.75 something, I think takers of about 45% of the participants in the survey look at 0.75 being possible. For me, the most important thing would be what they would do with balance sheet reduction, whether they will actually announce it, or if they do announce it, what will be the quantum of reduction per month, because 95 billion per month is what is already discounted. Whether Federal Reserve will sound less hawkish looking at the way economy is already reacting is something that will be very interesting. At the same time, that is not likely to give much of a respite, because the rates are going to go up. Bank of England meets on May 5th. So despite some poor economic data, there will be a rate hike in this month, and the market is still looking at another 100 to 125 basis points hike this year. But again, this is an inflation fight, and a trade-off against the growth. So therefore, this will be again seen as a negative for the pound. Four other central banks actually meet this week. That is South America. We have Brazil and Chile, both of whom are closer to the end of normalization, and two from Central Europe, Poland and Z, where there is some more space to hike rates before they peak. And of course, Friday we have the non-farm payroll data, which is looked at with major interest, because the employment is the area where Fed is giving all the headroom for hiking rates. In fact, the wage inflation data last Friday was a shocker, and that actually has given further impetus to the calls for higher rates in US. German inflation also came higher, and again, German industry, which is the largest in the Europe, is particularly exposed to surging input costs, and firms and households are grappling with the mounting costs across across the region. So this has increased the chances of a hike in hike by ECB in July. On the dollar side, euro dollar seems to have found some support, more as a corrective profit-taking move, and possibly wait till FOMC meet to start the next move. There is a possibility we go up to 1.0630 in a correction. On the dollar end, of course, again, the profit-taking is again playing its part. Levels above 130.50 are proving to be a good attractive level for profit taking. But none of these actually, central banks are actually now talking about the need to arrest their currencies fall. It looks like it's a case of benign neglect. Talking of benign neglect, even Chinese yuan has hit a 18-month low on Friday and slid more than 4.4%, 4.5% in April, setting the course for the worst month since the currency market reforms started in 1994. In fact, some people are, saying that Chinese yuan will follow the footsteps of yen, which has fallen more than 10% in the last couple of months, and because it's all a competitive devaluation that is happening in the market. But talking of competitive market devaluation of currency, rupee is steadfast in the very familiar range of 76.30.40 to 76.80, with the RBI playing a big part in ensuring stability and non-disruptive macro indicator of currency. We did have some domestic macro indicators. GST collections hit a new high at 1.67 lakh crores in April, which is 26,000 crores more than the previous high of 1.42 lakh crores. And these collections represent transactions of March and the result of higher economic activity, as well as measures taken by the government to plug leakages. If the trend is maintained, it augurs well for the fiscal position of the government. Forex reserves slipped to 600. That's a 42 billion drop in the last 8 to 9 months. Mainly FII outflows and the higher import bills are leading to the drop in the forex reserve, because RBI has been supplying dollars at every spike up. India's core sector growth also slipped to 4.3% from 6%. Three of the sectors only recorded growth, that is cement, fertilizer, and electricity. Rest of them all, coming lower. So on the rupee, we still don't have any macro factors supporting a strong rupee. Trade deficit or higher financing costs, the lower inflows, and as well as the oil price, which is shooting up. All these, argue for a weaker rupee, but possibly that it's the timing that the market may be getting it wrong, and we could see eventually this happening after this week, when we have the IPO ending, as well as the key data from various countries also giving a clearer picture. Technically, 77 has become very important for future direction of the rupee, particularly if DXY sustains the current strength. If a break of this level can see a move up to 77.50 swiftly. From the market side, we see the demand still dominating broadly due to the oil price, as well as the ballooning trade deficit. On the yield side, of course, we have the 10-year yield cutoff came at 7.17 on Friday, and it closed at 7.14%. Expected that it will move higher towards 7.20 before the FOMC meet. Though the large GST collection will be supportive of a bond market to some extent. The Asian currencies have been weaker today. Of course, the Korean won has slightly strengthened because of the fears of intervention, but Chinese yuan is very, very strong. In a strong downtrend, moving towards 6.69 once again. So that's it, and we have a lot of big plate of data this week. Also, to remind you that tomorrow market will be closed due to bank holiday, and yes, we see you on Wednesday with a new update. Thank you.
Okay, that was amazing and also a bit long, but what can we do? I mean, there is so many updates that are going around the world that we have to cover as many as we can. And talking about updates, we do have another one for you. We are coming up with a very special series for all the folks out here, the who's who of finance by Almus Risk Consulting. Now, we are calling some really good host over there as well as the guests to speak and talk about the financial markets in the best possible manner and bring out to you the amazing insights, raw and more deep towards the financial markets. So, folks, I expect you to be joining us over there as well. We take your goodbye for now, and we'll catch up again tomorrow, day after, as we celebrate Eid tomorrow. Eid Mubarak to rest of the folks who are there celebrating Eid. We take goodbye. Thank you.